All right, welcome to The Explainer. Today we're jumping right into a question that honestly splits Wall Street right down the middle. Can you consistently beat the stock market? We're going to explore the strategies of the active stock pickers and weigh them against the really compelling case for just passively investing. Let's figure out which path might make sense for you.
So, here's how we're going to break this all down. First, we'll talk about this quest to beat the market. Then, we'll dig into 4 so-called proven strategies people use to try and get an edge. After that, we're going to face the cold, hard data, the counter-evidence. From there, we'll uncover the powerful principles that really drive success, and finally, we'll talk about how you can choose your own path.
All right, first up, the market-beating quest. This is kind of the holy grail of Wall Street.
You know, this is the question. It's the one that splits the entire investing world into 2 big camps. You've got the active investors on one side. They're the hunters, always searching for that next big winner. And on the other side, you have the passive investors, who basically say, why try to find the winner? Let's just own a little piece of everything. It's a total clash of philosophies.
And look, don't get me wrong, this is a huge business. We're talking billions of dollars spent by professionals, the smartest people in the room, all trying to do one thing: outperform the S&P 500. They have teams of analysts, supercomputers, the whole 9 yards. But does all that time, money, and brainpower actually work? Well, the results are pretty eye-opening.
Okay, let's just cut to the chase and look at the actual numbers. A really revealing study by Standard & Poor's found that over a 5-year stretch, only 12%, just 12% of professional fund managers actually managed to beat the S&P 500. Just let that sink in for a second. That means a whopping 88% of them failed to beat a simple, boring, passive index fund. This one stat is really at the heart of this entire debate.
Okay, so if the big shot professionals are struggling so much, what hope does a regular person have, right? Well, the folks who believe in active investing will point to 4 proven strategies that they argue can give anyone an edge. So let's break them down. Strategy number 1 is actually pretty straightforward, and honestly, it's kind of beautiful in its simplicity. The idea is to invest in companies that consistently share their profits directly with you, the shareholder, through dividends. These are often stable, established companies that are basically paying you just to own their stock. It's a steady income stream on top of whatever the stock price does.
And you want to see something wild? The history on this is just wow. A study by Ned Davis Research looked at S&P 500 stocks all the way from 1972 to 2015. They found that if you put $100 into stocks that didn't pay dividends, you'd end up with just $291. But that same $100 in stocks that did pay dividends, it grew to an incredible $4,385. That's a massive difference.
All right, strategy number 2 is all about finding companies that buy back their own stock. The way to think about it is pretty simple. Imagine a pizza. If the company removes a few slices, everyone else's slice gets bigger. That's what a share buyback does. It reduces the number of shares out there, which makes your ownership stake just a little bit bigger and, hopefully, more valuable.
And this isn't just theory. Let's look at a real-world example. There's a fund that specifically invests in these buyback companies. Over a decade, a $10,000 investment in that fund grew to over $23,000. Not bad. But the S&P 500? That same $10,000 only grew to about $20,600. So yeah, that's a pretty clear advantage for the buyback strategy in that period.
Now, our third strategy is a bit different. It's less about what specific stock you pick and way more about how you approach investing. This is the classic buy and hold philosophy. It's all about tuning out the noise, resisting that temptation to jump in and out of the market, and just holding on to good investments for the long haul. We're talking years, even decades.
You know, there's this quote from US Bank that just nails it. Instead of trying to time the market, consider spending time in the market. The data here is pretty incredible. One study showed that while the S&P 500 definitely has its down years, it has never, not once, lost money over any 20-year period since 1950. That just goes to show you the power of patience.
And that brings us to our last strategy, which, honestly, it might be the most powerful force in all of finance: compounding. It's the magic of earning returns on your returns. When you take those dividends and use them to buy even more shares, you kick off this incredible snowball effect that can turn a small, regular investment into an absolute fortune over time.
So let's put some real numbers to this to see how insane it gets. If you invest just $500 a month and get a pretty reasonable 6% return with those dividends reinvested, well, after 10 years, you've got almost $90,000. Stick with it for 20 years and you're at $250,000. And after 30 years, you're looking at over $500,000. That is the unbelievable power of compounding right there.
Okay, so those 4 strategies, they sound pretty solid, right? I mean, they make a really strong case for trying to pick your own stocks. But now we have to look at the other side of the story. There's a mountain of evidence that suggests trying to beat the market might just be a loser's game. Let's dig into the counter-evidence.
And it all starts with this one question, made famous by the legendary John Bogle, the founder of Vanguard. He called it a loser's game. The idea isn't that you can't win. It's that the odds are so stacked against you because of fees and trading costs that the very act of trying to win makes it more likely that you'll actually lose. It's a radical idea, but it's backed by a ton of data.
And look, this is not just some philosophical idea. It's a cold, hard, statistical reality. The SPVIA scorecard, which is like the official scorekeeper for this debate, shows this year after year. The longer your time horizon, the harder it is for the pros to win. After 5 years, about 3/4 of them fail. After 15 years, that number jumps to over 90%. The odds just get worse and worse.
But here it is, the number that really just stops you in your tracks. Over a 20-year period, a staggering 94% of professional large-cap fund managers failed to beat the S&P 500. Let me say that again, 19 out of 20 experts, with all their research and resources, would have gotten better results for their clients by just buying a simple index fund and leaving it alone. It's just a brutal statistic for the active management world.
It's this kind of overwhelming proof that leads guys like, Warren Buffett to say what he says. He's been screaming from the rooftops for years that, for most people, the best way to invest isn't to try and find the needle in the haystack. It's to just buy the whole haystack with a low-cost index fund. There's this fantastic analogy from economist Burton Malkiel, and it involves golf. Stick with me here. He says active investing is like trying to be a pro golfer. You spend a ton of money on fancy clubs and lessons. You're always trying new things, but you almost always end up shooting over par. But index investing? That's like being guaranteed to shoot par on every single hole. You'll never get a flashy hole-in-one, but you'll beat almost everybody else on the course, and you barely have to try.
And you know who else agrees? Peter Lynch, one of the few guys who actually did consistently beat the market. Even he admitted that for most people, the best move is what he called the dartboard method. Don't waste your time trying to hit the bullseye. Just buy the whole dartboard. In other words, own the entire market.
Okay, so where does that leave us? It feels like a paradox, right? On one side, you've got these strategies that seem to have some merit. On the other, you've got a mountain of data saying, don't even try. So what's the real secret? What are the principles that work no matter which side of the fence you're on?
Well, it turns out that when you cut through all that noise, the real secret to success isn't about active versus passive. It comes down to 3 incredibly simple but powerful principles. These are the things you can actually control, and they matter more than anything else. Number 1, and this is maybe the most important of all, keep your costs low. Seriously, high fees are the silent killer of your returns. They're like a constant drag on your portfolio that eats away at your money every single year. Get this, some research shows that just avoiding a typical mutual fund fee could mean you end up with 47% more money after 30 years. That's an insane amount of your hard-earned cash to just give away.
All right, principle number 2 is all about consistency. The idea here is to invest the same amount of money at the same time every single month or every single paycheck, just like clockwork. This simple discipline takes your emotions completely out of the game. You're not trying to guess what the market will do, you just buy. And in doing so, you automatically buy more shares when prices are cheap and fewer when they're expensive. It's simple, but so effective.
And that brings us to the third and final principle, patience. You've got to give it time. In the short term, the stock market is a total roller coaster. It's unpredictable. But over the long term, it has historically been an incredible engine for building wealth. The longer your time horizon, the less risk you have of losing money. Remember that stat? Over any 20-year period, the market has always gone up. Time is the most powerful tool an investor has.
All right, so let's tie all this up. We've looked at the appeal of trying to beat the market, we've stared into the pretty overwhelming evidence against it, and we've boiled it all down to the core principles that really matter. So, what does this all mean for you and your money?
So what we learned? What should you really walk away with? Well, here's the bottom line. First, actually beating the market is incredibly rare and almost impossible to do consistently. Second, your real power comes from focusing on what you can control, keeping your costs rock bottom and investing consistently. And third, having the patience to buy and hold for the long term has historically been the most reliable path to growing your wealth.
So it all comes down to this one last question, and it's for you. Knowing what the odds are, what game do you actually want to play? Do you want to play the high-stakes, high-cost game of trying to find that needle in the haystack? Or do you want to play the patient, disciplined game where you're almost guaranteed to win simply by not losing? The choice is totally yours, but now at least you can make that choice with your eyes wide open.